Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, September 21st, 5:29 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. And it's not a good one if you're a bull. State of the market, we're in a correction. The correction got deeper today. You can see over here on the trend gauge, we've already been in bearish/downtrend mode across all three time frames that we track the five major indexes, meaning they are trending below their short-term 21-day exponential moving average, below their medium-term 50-day moving average, and below the long-term 200-day moving average. Leading stocks, there have been about 12 to 15 holding up and showing leadership quality action if the market would participate. The market not participating, no real major sell-offs relative to what the indexes did today in most of them, but the arrow's still going to neutral. A couple that we watch broke their 21-day exponential moving average today. So what just happened today? The bear is back. Nasty end-of-day sell-off after Powell's statement and speech. We actually had an intraday cup and handle breakout that failed miserably into the close. So here's the rundown first of all, then we'll look at the charts. G6, this is our growth proxy. We use this as a signal to us whether or not the environment for small and mid-cap growth stocks is healthy. It's a composite of 6 growth ETFs. We add it up, divide by 6 every day and track it. They're technically unhealthy and today down minus 1.71%, S&P down 1.7, NASDAQ 100 down 1.8, Dow down 1.7, mid caps and small caps a little bit better. Mid caps down 1.34%, Russell 2000 small caps down 1.4%, global diversified 60/40 stock and bond index down 0.90%. Somebody asked how we calculate this every day. We use 60% of the ACWI ETF and 40% of the BNDW ETF. That's a global index for stocks and a global index for bonds. VT is also about the equivalent of the ACWI. ACWI is more liquid. That's why we use that. So that's how we calculate it on a daily basis. And in-house, a little bit of a loss today for GROTECTION as we did get sucked in on some of the positive action. Down a third of what the indexes were down 0.68%. Still profitable since the last move off the bottom that we got involved in. And all our stops will take us out before we go negative relative to that. So year to date down about 7.5%. The index is now down, or the S&P now down back over 20%. That's why I said the bear is back, as we dropped below that 38.13 level, which was the 20% drawdown. We'll get to the tail of the tape and some charts of interest. Charts really not that interesting after today. We will take a look at a couple though, but let's discuss why we do what we do here at Revere Asset Management. We do trend following. It keeps us in the market when the market's trending higher. It keeps us somewhat out of the market, but still in if we're consolidating and going sideways. And most importantly, it gets us the heck out of the way if the market is in a bear or enters a severe bear market. Here's a look at the last 13 bear markets going back to 1968. The ones that are highlighted are the severe bears. On average, they lose 44.5%. That means you need 80% on the S&P to get back to even. Right now, Jan to July of this year, our sell-off was minus 24.5%. We're in the midst of threatening the third leg lower that'll take us below that. We'll see how that unfolds, but if today's action was any indication, not a good session for the bulls and not a good outlook either. So why do we stress this so much? It's because of a sequence of returns. I watched my father-in-law's managed account by one of the big brokerage houses get run into the ground while he was dying of cancer back in the when the tech bubble was bursting, and his widow was left with half of the nest egg that they had I see people buy and hold, stay in there. They think that they can show a long-term trend that the market's up and that therefore everybody's lives should be happy. There are events in these people's lives, in any investor's lives, that they need the money when they need the money. And if it's in the middle of a massive drawdown, you're screwed, plain and simple. And that's why we make risk management our number one priority here at Revere. If you control the drawdowns, the returns will take care of themselves when the market gets back into a bullish phase. And right now, we're in drawdown mode or bearish mode, as you can see. Well, when we're trending nicely higher, as we were last October, November, above all three time frames, we're participating in the market. When we start to go sideways, break below the moving averages, our stops will get hit. We'll take a step back. If we really start to roll over and the slope of the lines of the shorter and medium term moving averages roll over, we'll get even more defensive. And then if we break below this black line, the 200-day moving average, all of these severe bear markets take place below the 200-day moving average. That one simple rule will save every investor a lot of mental and financial capital, save you heartache, however you want to put it. But not only do we have rules to get out, we've got rules to get back in. When we bounce off of support levels like we did back here, around 3,700-ish, thought we had a bounce yesterday below this 3830 level when we undercut and reclaimed, and then had a false breakout today and then broke down at the end. So this triggered some of our stops. We'll talk about the details of what we did today, where we got sucked in and where we took cut losses, not took profits. But you can see the move higher. We ran right into the declining 8 EMA today. That's the purple line. That's our ultra short term moving average. And then we reversed and made new lows. So now we're at 9-week lows on the market. If you're interested in a common sense approach like this, why do I call it common sense? Because what other aspect of your life, when things go wrong, don't you take corrective action? We think that your finances should be no different, and the market puts off very clear technical signals to tell you when the market is healthy and when the market is risky. And you just follow those signals, you can stay out of trouble. And then, as I said, when the market's trending higher, the returns take care of themselves. But the key is to compound from a higher capital level so that you never have these massive drawdowns that you have to recover from. So if you're interested in this approach, email either Don or Dan at revereasset.com. Dan's my partner. He's the president of Revere. He's a CFA. He is Mr. A to Z when it comes to all things financial, and he'd be glad to talk to you. So email either of us or call 855-REAL-WEALTH. That's 855-732-5932. So there's your S&P 500, NASDAQ 100 QQQ. We took an entry in the QLD yesterday. It broke out. We had nice profits. We ran into the ADMA and it reversed. Let's take a look at a 5-minute chart on this, and it's very clear what happened with the Fed. So here we are going sideways, tight range into the Fed. The initial move down. The initial move is usually a false move. And we've been talking about this 286.82 level, this fib. We undercut it again for the 4th day in a row and recaptured it within 20 minutes. So, and then we formed an intraday cup and handle. It's very clear on a 1-minute pattern. Here's your cup, here's your handle. These patterns are fractal. Very nice breakout of it. We bought SSO when this happened on this breakout, 10% SSO, and we made new highs. Everything's good so far, and then we rolled over. We tested, no problem. First test, not a problem. Very frequent that you back test the breakout area of a cup, and then we started to go higher again, and then we started to roll over again. And then we broke below, and then when we came back up, couldn't make a higher high. All bets were off. We started to roll over. We sold our QLD. We sold one of the other positions that we had, and then we just watched this drip lower into the close. So I'll break it down in more detail when we go over the tail of the tape, but the S&P 500 looks very similar to this. So here's the S&P 500, the initial reaction down, perfect cup and handle, breakout, failed breakout, back test. Okay, so far, let's see if we can make a higher high. Nope, roll over, another failed rally, lower lows, lower highs, big fade into the close. So 9-week lows, as I said, as you can see on the S&P 500. Let's go to the Dow Jones Industrial Average. And closer to all-time lows, or recent lows, not all-time lows, closer to recent lows with this one. Again, a clean break, reversed at the 80 MA. MDY is our mid-cap index, broke. Still $26 lower to get to the 400 support level on there. So note the relative strength has just been little by little ticking higher in small and mid caps going back to July, but the chart looks terrible. A mild outperformance on relative strength is no substitute for the price and volume action. Same thing here on small caps, mild outperformance, but again, we broke recent lows. So consistency across the indexes, all 5 of them breaking recent lows. What does this mean that we would do for the remaining positions that we have? Well, we would be selling into strength again with this most recent breakdown. Meaning, and the expected resistance level will be the support level that was just broken between 3,800 and 3,830-ish. So let's bring up the tail of the tape here, compare it to what's going on with the indexes. Put call ratio relatively low at 1.05. The VIX did spike back up to 28, but still only up 3% considering how harsh the move is. Let's take a look at the VIX here. The symbol is 0 VIX. In MarketSmith, you can see new closing highs going back 9 weeks, also above all the moving averages. That's not good if you're a bull. Fear and greed dropped to 31, still in the fear, approaching extreme fear if it gets to 25, still operating under the bear case since 9/13 with a big CPI gap down, or big move down, gap down pre-market, move down, continued lower. As far as the news today, something weird pre-market. Putin called up 300,000 troops as they were planning to escalate the war with Ukraine. Northrop Grumman and some of the other defensive stocks had an initial pop on that, and we were green pre-market on that news that came out. But then the FOMC, the key takeaway for me was when Powell said the message has not changed since Jackson Hole. That's what caused the initial sell-off prior to the CPI sell-off, and now this is sell-off number 3 here. They're telegraphing another 75 basis point hike after this one, and then another 50, and then another 25 into next year, and then no interest rate cuts. But the economy ultimately will, and inflation numbers will ultimately have the final say so as far as what actually happens. So today we went from 4 out of 6 days down now to 5 out of 7 days down, and new 9-week lows. Expectations coming into today were really neutral and had no way of knowing what Powell was going to say and how the market was going to react, but the negative close certainly answered that question for me. Broke below support on these key levels, the support level 38.15 on the S&P and the 286.82 on the NASDAQ 100, closed below there. Rallies up to there. As I said, these should turn into resistance now, and those would be, for example, an area where we would get out of SSO, the SSO position that we put on today. So gapped up nicely, tight range into the Fed, cup and handle intraday breakout failed, nasty last hour close at the lows. What was strong today? UUP, which is the US dollar, and that again certainly does not help stocks. That's a breakout on the US dollar. Let's look at the 10-year 0TNX on MarketSmith. It actually went higher and then reversed, still holding this 8 EMA. That's the purple line as we go higher. So bonds up means yields down. Gold had a little bit of a positive reaction today, but 11 out of 11 sectors were down, most notably the weakness in biotech, jets, that's the airline ETF, and uranium. We'll take a look at these focus tickers to see how they ended up reacting. But as far as the portfolio went, 4% CMG is what we bought. I've been talking about wanting to get into this for a while. We got a nice low risk entry above the 21, broke to higher highs intraday. But if you look at a 5-minute chart, it looks very similar to what happened with the Fed. So we'll second close below the 21, and this will be gone, and we'll be out with a very small loss on that. And then we bought the 10% SSO on the breakout, which ended up failing. When the breakout failed, we sold our QLD. So these kind of netted each other out, the 10% SSO add, the selling of the QLD. And then ENVX is just too volatile to hold with the market breaking down like this. I know it held the 21 EMA, but this has a double-digit ATR. I'm not going to hold something like that in this market. So we're down to 4% CMG, 1.5% Tesla, and 10% SSO. Bottom line, very negative end-of-day reaction to the Fed, new 9-week lows, back into the bear, more than 20% below the year-to-date, which is the technical definition of a bear market. Let's take a look at a couple of charts that were on the focus list. So these were really the cream of the crop in the 21 over 21. Lithium down 1%, very mild reaction today. We already looked at CMG. Tesla, considered adding to this. Glad I didn't when we had that breakout. It reversed, closed right at the 300 level on the ADMA. 300's a big area. Maybe give this one a little bit of room as it's been acting so well over the past 3 weeks. But we're not gonna. We're at this point looking to reduce exposure after today's reaction, and any pop off of that, unless it has massive volume for whatever reason. You never say never with the markets. Next up, Enphase. Solar stock started out lower, rallied, and then reversed, undercut, closed right above the 21. So this chart still looks fine, but do note right near overbought, a negative stochastic crossover today. So that's a red flag also. Another solar stock, really the king of the solar stocks, First Solar. Again, outside reversal to the downside, closed inside yesterday's candle, which I guess is bullish, but again, note we're rolling over from overbought conditions there. That's also not good. Wolf, WOLF, one we've certainly been watching, negative reaction on all of them, still closed positive on the day though. LNG, our favorite oil and gas stock, not a bad day, down 1.5%, still above its 21. BJ's closed right on the 21. It's been pulling back, but still showing relative strength. CEG, an alternative energy, down less than 0.5%. I mean, these stocks continue to still hold up well. Not a single one of these has decisively closed below the 21. Shockwave is the last one. Okay, there's not decisively, but closed below the 21. CMG did too, so 2 of them did. And then, of course, Apple, which you always have to monitor to take your direction, your market direction from there, briefly got above the 21, reversed, closed at the low of the day along with the indexes. So Apple's below all the key moving averages, showing some nice relative strength this week, but down 2% today, basically in line with the NASDAQ 100. So that's going to wrap it. Nasty end of day sell-off puts us back in bear mode. Down 20% year to date, time to get defensive, not to be a hero, blah, blah, blah. Let's take a look very quickly at what the year to date numbers are. I have them in a spreadsheet off of my screen. So year to date, the S&P is now down 20.48%. We are down 7.7% for the most part, but a 1,274 basis point or 12.74%, however you want to look at it. That's our lead over the S&P 500. It's a nice cushion. These entries that we take back into the market aren't without risk. We keep the risk small. Anytime we take a step in, we're risking 1 to 1.5%. In fact, every time we've done it, the most that we've lost is 1.1%. That was the last time we dipped back in. The other times we dipped back in, down 0.9%, down 0.1%, down 0.9%, down 0.5%, positive 0.4%, down 0.6%, positive 2.6%, and this most recent one is still slightly positive. So there's not risk. We're not going to time the market perfectly, but we do have our risk management rules in place that will limit the damage to a paper cut. And then every once in a while you get a nice big rally like this, which takes care, a nice big trend, takes care of all these little paper cut losses, and then one of these times it'll continue above resistance. It'll break above the 200-day moving average on the indexes, and we'll be back in a new bull market, and we'll be capitalizing from being only down 8% instead of being down 20, 25, 30% or more like the S&P is, and that's called crisis alpha. It's a big part of our approach here at Revere, knowing when to get out of the way. So that's going to wrap it. Ending up September 21st, reminding you it's not how much you make, it's how much you keep. Thanks for listening. Have a great day.